Now, let's take a quick look on what a compound journal entry is. So, a journal entry that we have studied till now involves two accounts. But what if a journal entry has two plus account? Well, it just sounds so technical, but it is not. So, let's see the example right here. If a debtor is allowed cash discount and he makes the payment, then the accounts involved are: first account that is involved is a debtor. Second account that is involved is cash that we have received. Third account that is involved is discount. Okay, so we have identified all the accounts. That is why I have always named in the cheat sheet all accounts. Second step is categorize each account. This one is debtor. Debtor is a personal account as it is a person. The second one is cash. It's a real account. And discount. Discount is an expense. It's a nominal account. So let's start with cash because it's the easiest one always. So cash came in because the debtor made the payment. Okay, so cash came in. Cash is a real account. Debit what comes in, hence cash is debited. Okay, debited. Discount is a nominal account which is expense. Debit all expense and losses, credit all income and gains, hence this should also be debited. Okay, this is also debited. Now debtor is a person. Debtor has paid us something, so debtor is the giver, hence debtor should be credited. Debit the receiver, credit the giver. Okay, hence this is credited. Okay, as you can see the journal entry here: cash account debit, discount account debit, debtors account credit. So instead of writing credit here, we write 2. 2 is a representative of credit, hence we can write credit also, but this is a more popular format which says cash account debit and debtors account credit. So the 2 comes here. I have with me an illustration. This is illustration number 5. So which will give us more clarity with the compound journal entries. Commenced business with cash and goods. So what are the 3 accounts involved? That is cash, goods and capital. Okay, so cash is a real account, goods is also a real account as it is an asset, capital is a personal account. So the third step is golden rule. Cash came in, debit. Cash came in with the perspective of the business. Goods came in with the perspective of the business. That is debit. Debit what comes in, credit what goes out. And the third one right here is credit. So this one will automatically be credit. If you want to check it, this right here, you can see this: debit the receiver, credit the giver. Okay, now let's check out the second compound entry, which is purchase goods from X and company for rupees 10,000, paid rupees 5,000. You can imagine any currency here, the currency of the country you belong to, or you can imagine dollar here, doesn't matter. So what are the 3 accounts involved? The first one is goods, or we'll refer to as purchase account. The second one is X and company. Okay, the third one is cash. So first let's handle cash. Paid cash, so cash went out. It's a real account. Cash went out, we should credit it because credit what goes out. X and company is a personal account, so we have purchased goods from X and company. X and company gave us the goods, so X and company is the giver, hence and X and company is also credited. Goods purchase, so goods came in, real account, debit what comes in. Okay, so and we'll write the relevant figures in front of them. Cash is 5,000, 5,000. Okay, and goods purchase are 10,000. Okay, 10k, and the left part is 5,000 because X and company has 5,000 rupees due. You can check the entry right here, which says purchase account debit, okay, to cash to X and company. Okay, this is the correct entry that we made. So let us now go the reverse way and check out another entry and try to frame an equation or a transaction or a question from that entry. So right here this entry says, this is a compound entry, this entry says cash account debit Y income debit to sales. So this is sure that a sale is made and the goods went out. So rupees 30,000 sale is made, and as cash was received, cash cash is debited, hence debit is what comes in. So rupees 20,000 came in from the cash, and Y and company is a person. A person is debited, so debit the receiver, hence rupees 10,000 is due from Y and company, which makes it our debtor. Okay, also you can read this narration here: goods sold to Y and cash received from him. So only 20,000 cash is received and 10,000 is due.